Hello guys, welcome to another video. I'm Adi from Pixel Profits, and this is part 5 in my series of videos on market structure. This one's going to focus on internal and external liquidity and how price moves between the two. If you haven't seen the other videos in the series yet, there's going to be a link on the screen now. You will need some of the information in those videos in order for this one to make sense. So go take a look if you haven't already. Okay, so let's talk about external and internal liquidity and what they are. Price moves generally between internal and external liquidity and back again. And we can identify points of interest in the market where price is likely to move to next. Now, obviously, we use this in confluence with everything else we've already learned in the series, but let's take a look at what I actually mean here, and then it'll become more clear. So on the screen here, we can see some examples of the things we're going to use. Let's just cover them one by one. So an example of external liquidity is when old highs get swept. Okay, so there's liquidity, and I mean, I can draw a separate one here as well for you, just so you can see this. Now, this obviously happened quite far in the past. There's no requirement that it has to be this far back in the past. You could take this high here and say that that's been swept, and then the move happens. But what I'm trying to illustrate to you here, let me just extend this out a little bit so you can see. You've got all these highs resting up here, and you've had a big drop down, and then price comes back up. It sweeps above those highs just with a wick, no body close on this one, and then we get a massive move down. So price has come up, swept out all the liquidity that's resting in here above all these highs, and then it's dropped down. So that's basically the essence of highs and lows used as external liquidity. Like I said, you could use this one. External but just means on the outsides of the sort of current price range. I mean, even these are external liquidity points that could be taken, right? This one's got taken by this one, for example, and this here has been taken by this. You can easily consider them external. It's a bit subjective, and it doesn't really matter because there is internal highs and lows that are also swept for liquidity, but we're just focusing on the external ones, or external liquidity, and that one of those concepts is sweeping highs or lows. Okay, same things happen down here, right? We've got lows that have been swept down over here. Okay, good. I think that's pretty clear. Let's move on. The second external point that we're going to focus on is what we call an origin. An origin is generally the last move before a large expansion. So last move in the opposite direction, and basically what that results in is also a change in the state of delivery and an order block, as we recognize here from our past video, our previous video on changing the state of delivery and order blocks. So often an origin will end up being a similar place to a change in the state of delivery. And what we generally judge it as is the entirety of the last up move before a down move, or the last down move before an up move. Okay, that'll be an origin. And origins often, when they get revisited, they provide a nice reaction. Not always, but it's a point of interest that we can certainly start looking for things to occur at, especially when it's got an order block as part of it. So those are our two external sweeps of highs and lows and origins. Now, internal liquidity, we're going to use order blocks as internal liquidity as well. Okay, and we've already covered that in the previous video, so I won't go into that anymore here. But the second concept for internal liquidity we're going to use is fair value gaps. And I've drawn a couple of examples on here for you to have a look at. I'm just going to tidy this up a little bit and get rid of these for now, just so we can focus more on what's actually happening here. So, fair value gap, what is it? Well, when price moves quickly, as it has here with this large expansion candle, away from an area, we get what's called an imbalance or a fair value gap. Now, the way we work out how we're going to draw them is it's a 3 candlestick pattern. Let me just put some markings on here. There's the first candle, okay? And here is the third candle. There's no particular requirement for anything to be bullish or bearish. It's just that a fair value gap with a bullish candle in the middle is sort of a requirement. But the two candles on the outside of the pattern, the first candle and the third candle, there's no particular requirement for them to be anything. The important part is that what we can see here is that there's a wick here, and I'll draw a line out. There's a wick there, okay, that ends. And then we take so that's the first candle. Then we take the third candle, we find the wick of the third candle and extend it out. And what do you get in between those two wicks? There is no crossover of these wicks, okay? If we look here at this candle, and we take this as the first candle, this is the second, and this is the third, we can see that the candle of this wick came right up, it even went above the high of this candle, okay? So when we then get this next candle, and then the third one, you can see quite clearly that this wick overlaps with that wick. So the first and third candles wicks there overlap. So that is not a fair value gap. Let me draw another one to make it clear. Here's the first candle. There's a very tiny wick there. We've got the second candle, the third candle, the candle of the wick of the third candle is right there, giving us a bullish fair value gap. You can see again the first candle's wick does not overlap with the third candle's wick. What does that actually mean? What does this actually show us? Well, what it shows us is there's an imbalance here, because where in these candles we traded over each other and we had an area of even consolidation here, price was balanced here between buyers and sellers. But here there was a big imbalance of buyers and loads of buying pressure coming in, but maybe that left behind either people who want to buy or people who didn't quite get their orders filled because the price moved away from where their order was, their sell order, too quickly. So what we often have then is that after the third candle has formed and we get a confirmed fair value gap, we often get this retracement into it. And if we have a bullish one, we expect that a good potential that it's going to provide support for price to go higher. Same thing happens here. Price comes down, it wicks through, but it can't close anywhere through it, and then it supports price higher. The opposite happens in a bearish move. So here we have the first candle, the second candle, and the third candle. We can quite clearly see that between the wick here and the wick of the third candle, there's a gap. Price has moved quickly through this area, leaving a lot of people without their orders filled. So there's a good potential that at some point in the future, price might come back, and this one, well, price has just dropped like a stone. So they don't always get retouched. Perhaps it will in future somewhere on the chart, but they often provide a good reaction. They often provide good support for price. Now, you might have noticed here on this one that price comes up, taps into it, provides support, but then we come up and then we close right through it, completely disrespecting it here and closing right through it. When this happens, we call it an inverted fair value gap. And what that means basically is that it's been completely used up in the opposite direction to where we expected it to support price. It's actually failed to support price, and now it becomes an inverted fair value gap. And what often happens is these also provide a good area of support and resistance in the future. And again, this price has just dropped. So there's no revisit of this zone, at least on the immediate part of this chart. But in essence, once a fair value gap gets closed through, disrespected, it often acts as support. And here, I mean, it's acted as support here, and it's got closed through, and then you see this area of consolidation around it, and then price pushes even higher. So that is our four concepts then. We have fair value gaps and change in the state of delivery / order blocks for our internal structure or our internal liquidity. And for our external liquidity, we have the sweeps of highs or lows and the origin of a zone that created a big drop. You can think of it as very similar places to these highs and lows, and often they result in an order block being created as well. So it's an order block at the origin of a large move. Okay, so if we consider that price moves between internal and external liquidity, let's jump over onto a chart and have a good look at that. Okay, here we are on a multicolored rainbow chart with all kinds of stuff going on. But I've drawn, well, not everything, of course, but I've drawn a lot of stuff on here. Some things, like this, I've missed out, but I'll put it on for now and we can come back to it in a minute. But basically, I've drawn a lot of different areas on here to show you how price reacts. Let's just talk our way through it, okay? So we can start over in this area here. And I've drawn some things from the past. You'll see why in a moment. But let's take here we have a good size origin move here. Okay, here's an origin. The price has created a change in state of delivery in an order block, and the price has dropped very far, very fast. Okay, that creates an order block, and that creates this zone here as an origin. I'll draw it out. There's a bit too many colors on this chart, but you know, you don't need to have all these zones marked out when you're trading. But for me, just to show you guys, I sort of need to do this. Okay, so there's an origin with our order block. We've had a big drop down, creating a large fair value gap. Now I've marked that as an inverse fair value gap because you'll see why in a minute. So we come from external liquidity and we come through, and what we actually do is go down into this origin here to external liquidity again. Then from this external liquidity, we come back up and we start moving into this internal fair value gap. And we can see we get a number of reactions from this fair value gap area here. Okay, a number of reactions coming off of it. And those reactions, this first one, let me just move that little so you can see the wicks. This first reaction from it comes down back into the origin zone and then back into this bullish fair value gap here, which supports price higher. We then come up, we take out these external highs, and we push up back into this internal fair value gap. We drop down again, more support from a fair value gap there, and then we come up to this external liquidity resting at the order block, which is right there. In fact, it taps it to the tick by the looks of it, and we're inverting now this fair value gap, or soon we are. So we're using up all the orders in this internal fair value gap, and we're coming up to this external area, this origin and this external order block, and then we get a push back down back towards internal liquidity in the form of, at the moment, what would be this bullish fair value gap. We get internal support, and then we get pushed higher again back into the external liquidity, and we're back into this order block and origin again. We get resistance from there again, and we push back down, back to internal liquidity. We invert this fair value gap at this point here, and we also invert this bearish one here. There's another one there, but I haven't drawn everything, like I said, or there'll be too many things. So we come back down into this internal liquidity. We have a inverted fair value gap here, and we have a bullish fair value gap formed after it. Okay, so we tap back into those, use them as liquidity, and we start to push higher. We invert this bearish fair value gap, and then we use it as support. We come back down into it, use it as support to try and push higher. One more time back down into it, and then we move again towards external liquidity. We come back from the external into the internal bullish fair value gap and this bullish order block here. Okay, and then we move again towards external liquidity. Let's just zoom out a little bit. We come up into this origin, this external origin here, with a bearish order block inside it. When we hit that area, we get pushed down again from external back into internal, and we tap this fair value gap. Then we go back from the external, we invert this fair value gap here, and we come up above the highs this time. And then once we've done this, is actually a break of structure, right? So once we've broken structure, we expect a pullback. So we've taken the external liquidity, we've gone into this origin right back over here now. And once we're in that external origin, we then push back down, back to internal liquidity. Let me just zoom in. Let's get this so we can see it. We come up into old external origin area from the left. In the external liquidity, we sweep this external liquidity here with this high, and we push down, right back down into this fair value gap here. We don't quite make it to this one, and then we get pushed back towards external liquidity, and we now create a new origin for this push. Okay, we're pushing up, we invert some fair value gaps on the way up, we come back into this external liquidity. We've got an inverted fair value gap, we've got a bearish fair value gap underneath there. It's really hard to see, I think, because they're all layered on top of each other. And we also have an origin. We also have an order block in there. So we've got multiple things here to force price back down, okay, from this external area here back down towards internal. And that's exactly what happens. We drop back down, We come down into this inverted fair value gap, which, as we said before, they start to act as support. It does act as support, pushing us right back to the external liquidity, resting here. We get pushed back down again, back into this small inverted fair value gap here, and we tap into this bullish order block that's been formed on the way up. Let me just zoom a little bit so you can see a bit better. Guess what happens? We get pushed back again towards external liquidity, this time taking out these highs, and in this origin and all the other good stuff that we had in there. We sweep the liquidity, we come back down to internal liquidity. Here's a fair value gap. Here's a, sorry, that one should be bullish, of course. Let me just change that so we don't get confused. We have a bullish order block there with a fair value gap on top of it. I'm going to zoom in a little bit more. We come back into that and we push back to external liquidity. We end up sweeping the high here of this previous liquidity and the whole origin now. Now we've broken that, or at least we've swept it. What do we expect after we've taken external liquidity? We come back to internal liquidity again, okay, which we do here. After revisiting internal liquidity, we come back up and make a try for external liquidity. We've got this order block here, which I haven't drawn on, but I can just draw a line there for now just so you can see. There's an order block, a bearish one that would be. Oh, let me do it properly and then it's easier for you to follow maybe. External origin here, right, of the move down that took us back to internal liquidity. So we come back up, we revisit it, we don't quite close, get anywhere above it, so we revisit this order block, we get another push back down to internal liquidity from this external origin and order block to the internal fair value gap. Look, I mean, you know, we tap that to the tick. See that? And of course, this we could consider potentially as another origin, although it doesn't have an order block and it's quite a big move there, so difficult to draw an origin there really, but we could mark out this wick, for example, as an origin. You can do that. The zone is too big. Anyway, don't worry about that too much, because we know now we're going to push back likely towards external liquidity from the internal. So here we go. We go up, creating an a fair value gap on the way. We smash through everything this time. If we go back on the chart, we have all these, you see that, all these old highs over here and these origins that we tap into here. Okay, and then we expect to move back down to internal liquidity, right into this fair value gap. Right into, again, you know, I haven't drawn everything on here, this order block, right, this bullish order block. Okay, we get support from those and we push back up. We take out the external highs with a sweep, and then we come back down with a strong move from this origin, creating obviously another order block there, right, a bearish one. And we come down back towards internal liquidity. We tap right in, and I haven't drawn all this, but there's a big fair value gap here I think you can see that we tap into, and back into this order block here. I mean, you know, it's all right there. You know, if you have these things sort of marked out and you look, where are we going here? Where's this move going? Okay, we've got all this. You know, there's a lot of stuff in here which half of it we haven't drawn. But yeah, we come back to internal. We come, external, because we're going into these origin zones now and sweeping these lows. Okay, you see that? We swept the lows. Come back up into internal liquidity. Where to? Fair value gaps. And then we get pushed back down towards external liquidity, going back now down, sweeping these lows past this origin zone. Okay, almost into this fair value gap, but not quite. And then we push higher again, back into the internal liquidity. We go into this huge fair value gap here. We get a little reaction, but then we manage to push from this now, what would have been a bullish fair value gap at this point. We get pushed higher back into the external liquidity at this origin. Push lower again, come back down into internal liquidity, back into this fair value gap. We get a reaction back into another internal fair value gap. So there's a couple of internal moves in one go there. So, you know, it's not always external to internal, sometimes internal to internal. There's always anomalies. But we get from this internal liquidity, from this fair value gap, we invert this huge one here, and we come back down into this origin. Don't know if you can see it properly, but we sweep. I've put a very large dashed line there. We sweep out all these lows of this external liquidity. We tap into this origin zone here, which is also drawn under there somewhere is, or should be, a bullish order block, right? From this high, from the close of, or sorry, the body of that candle and above, comes back into that, comes back into this bullish, small bullish fair value gap, all this liquidity, back up we come into this origin again by the looks of it, or almost, not quite, back into these order blocks, and then we drop back down to internal, we come from the fair value gap and we go to external, and so on, and it goes on and on. So I went through that a little quickly because I think you guys are getting probably a little bit more used to the concepts we're using now. And if you're not sure about the fair value gap part of this, just go and check out my other video. I'll put the link on the screen again right now. Go and check that out because that will give you a little more information on all of these concepts to do with fair value gaps. What I want you to take away from this video is that we have external liquidity at highs and lows, and we have external liquidities at origins of a large move, okay? And all of those places can provide us with nice reactions when they're reached. The other thing you need to obviously consider is that order blocks are created often on these areas, as we see here, and also order blocks can be used internally as well to frame direction, as we saw in our previous video. Lastly, we've got fair value gaps. We have bullish and bearish ones. Usually we expect, as in this case, for a bullish one to get revisited and support price higher. But when they get closed through, they become inverted. And then we expect, and if we use this one as an example, it gets inverted by this candle here. Then it gets retested as, instead of support this time, it gets retested as resistance. And it provides resistance. Okay? Even here, when we get revisited here, it breaks above, but it gets a little reaction, then it continues higher. So even then it's trying to provide resistance. So fair value gaps, bullish and bearish, and inverted fair value gaps, all of them useful liquidity areas to frame ideas for trades. Now, one additional thing I want you to think about when you're looking at these concepts and you're considering where price is going to move to is that price only really does, let's say, four main things. Number one, it seeks out liquidity. Now, we've seen, many examples on this chart, on this very colourful chart, of that happening, right? We've seen where it's gone to seek out liquidity before it makes a new move. Pretty self-explanatory, we've been through it. But it also, the second thing it does, price, is generate liquidity. So, for example, when we get these sort of highs and things, we generate a lot of liquidity above here because there's a lot of resistance being pushed away from here. And when we then come up and take out all of these at the same time here, that provides a very, very strong fuel for a down move, right? So here we've built lots of liquidity above here, and then price comes up and takes it all out, and then that fuels a big drop. So it's generating in here, generating liquidity, right? Generating buy and sell orders of various types above these areas that haven't been triggered and then get triggered, and that then pushes the price in a direction. The third thing it does is rebalance imbalances, and we've seen many examples of that here where price pushes up but then comes back to revisit an imbalance, a fair value gap in our case, or an order block, where there's basically, and you can see actually an example of both there, right? There's an order block and fair value gap overlapping, nice reaction from there. But price is looking for these areas of supply and demand, or where there's been an imbalance in supply and demand, because there's going to be orders left behind in these two areas, okay? And that can be used as liquidity. And the last thing, and this is easily indicated, or most easily indicated, I guess, by a moving average. This is a 100 exponential moving average, but doesn't matter. It's all the same stuff, really, at the end of the day. What I'm trying to indicate with it is that number 4 of what price does is reverts to the mean. And that means basically that price reverts to an average or a fair price. Now, I'm not saying a 100 moving average is the best example of that, but it's just simply an example of it. And what we expect then is that price will revert to the mean and then move away, take liquidity, and then revert to the mean, and so on, right? And we can see that many times it's reverting back to the sort of average, fair, reasonable, whatever you want to call it, price. Okay? So we have seeks liquidity, generates liquidity, rebalances imbalances, and reverts to the mean. Now, if you consider all of these things we've learned so far in all the videos, including this one, in that sort of context, you'll start to see that, okay, what is price actually trying to do at the moment? Okay, well, here it's generating liquidity with all these highs. Now it's taken that liquidity, so it's seeked out the liquidity, and then it's reverting back towards the mean again, and so on. We can go over and over, and now it's rebalancing an imbalance, and it's going back towards the mean, and then it's taking liquidity. And yeah, I think you get the point by now. But if you consider those four things, it can be quite helpful as a way of sort of framing where price may go next. So I hope all that's made sense, guys. There's a lot of information in this video, I know, and I've probably rambled off subject a little bit, but just try and focus on the fact that price generally moves between internal and external liquidity points, and if you identify where they might be, then you might know A, where price may go next, and B, what it might do when it gets there. I hope you found that video useful, guys. If you have, leave me a like, leave me a comment. Any questions, I'm happy to help. If you enjoyed this kind of content, subscribe to the channel, hit that notification bell to see when I release a new video. I think the next video in this series may be on the fractality of price and how the same things repeat over and over on different time frames, and a lot of other information based around those concepts. So I might throw in a video of everything we've done so far, kind of planned out on a chart. So if that's something you want to see, let me know in the comments. But otherwise, I hope to see you in the next video. Take care, guys. Thanks for watching.